Welcome to the Dividend Talk podcast, episode 199. 10 stocks we never want to own. Dividend Talk is your number one podcast for all things dividend and stock market related with a unique European flavour. My name is Derek from Engineer My Freedom, and I'm joined with my co-host, European DGI. If you want to learn more about us, please visit europeandgi.com, where we have articles on dividend growth investing, including 30 European Dividend Aristocrats. While you're there, you might as well grab our free dividend portfolio tracker template. We also offer a premium dividend growth service featuring a bi-weekly newsletter, which includes stock deep dives, dividend stock cards, and access to our dashboard with over 130 dividend growth stocks. All of this is based on our very own dividend safety analysis. But enough about that. Please grab a cup of coffee and let's get started. 199 episodes, European DJ, getting close to 200 next week. That's incredible.
Yeah, I mean, 200 is like 200 hours, even more, because lately they're like 1.5 hours sometimes, right?
Yeah.
So probably more towards the 250 hours. Hey, look, 199, talking about discipline, right? I know we have missed 1 or 2 each year because of circumstances here, but yeah, it's been a pleasure. It's really been a pleasure. And yeah, the next one is coming up. So, but 200 still feels like, we've got another 200 to come. I don't know how it is for you, but
easy.
I could do another 200.
Easy 200. But hey, look, we'll leave that for next week. We'll celebrate that milestone when we
definitely
when we do that podcast. Let's jump on to the news of the week, and I think we cannot escape roaring kid. I mean, look, I don't be on Twitter much these days, but every time I've gone on, my feed is full of this guy's memes, people talking about him. I've seen he was up to about $500 million at one time. Is the world gone mad, or am I living in a bubble that I don't know what's going on?
Last time this happened, right, the stock market was also going into hype territory, and maybe that's happening here as well. But for me, the ironic thing is that I believe his Reddit, and again, we are a bit more like reaching the boomer category in 10 years, right? So we may not be anymore on the socials like this, but I believe in Reddit, he is called Deep Fucking Value, and he's talking here about GameStop. Yeah, and I understand why he says GameStop as value, because also the shorts and such at the time. But yeah, when I see this is just like, I don't know. I think he's just taking a piss of the entire financial community in Wall Street, and he's got a fan base. It's like cult-like. I mean, I watched only the first 5 minutes of the live stream yesterday, and I felt already like, in what kind of a bizarre world are we living when I was watching this? Like, he looks like Axl Rose to some extent.
Yes,
glasses and the headband and everything. Yeah, or even Andre Agassi is another one that you could say. I mean, he lost yesterday. Of course, he went up, right? But just yesterday, he lost 235 million on a single day. I mean, how many people we could retire with this, with just this money alone here with dividend portfolio?
Is it? I don't know the risk he's taken or what's on the line from. As I said, I haven't followed it too much. I've seen he was up. Someone said up nearly $500 million at one stage. Like, what is the risk he's after taking to get to those levels? Like, I can only think of the leverage that he's using in those.
Oh, he's mostly using option strategy in the end.
Yeah, I mean, it's crazy. Look, you always get someone like this, and I don't know if it's luck. I don't know much about him. He could be good at what he does. He might know what he's doing, but I fear for those that are jumping on the bandwagon, like they did last time that GameStop did this. And I personally know people who invested not large sums of money, I must admit, but actually starting to invest in GameStop
Yeah,
because of stuff like this. And that's what I
yeah.
worry about. People get caught in this.
Uh,
But
Actually, I did a tweet the other day this week where I asked people to send reply with a GIF file, a GIF picture of their number one position and having to guess. And there were indeed a few that said GameStop as their number one position.
yeah,
So that's very interesting. I mean, look, I can't judge about the business. I've never looked into it, and I will never look into it either, probably, unless it pays a consistent growing dividend. But I mean, being on FinTwit, this is like popcorn time. I mean, I find it very entertaining to see, but that's also about what it is. I would never follow this investment strategy to make GameStop my number one position. I can't deal with the volatility.
we have a show on 10 stocks we never want to own. We might as well make it 11 and put GameStop.
Let's add
GameStop,
GameStop to it. Yeah.
GameStop right at the top, right at the top of the
Yeah.
list. But look, we couldn't have this podcast and not talk about GameStop or talk about Rowan Kitty. It's been so much in our face. I'm ignoring all the noise. I'm ignoring all these diamond hands and all these pictures of profits and stuff.
Yeah.
Trying to block one at a time every time it comes up on my news feed. I don't want that shit. Honestly, I really don't.
No, me neither. But then let's get back to a company that's actually growing also really fast. And this one is really fun because, interesting, let's say, because ASML is shipping its high nano EUV machine to TSMC, and TSMC didn't want to buy one because it was considered too expensive. This machine cost 380 million. Yeah, so they decided to buy one, and we know that Intel has already received its first one that they are testing and everything. Yeah, so and they bought a few, I believe. So it's very interesting. Like this is what you have with a monopoly.
Yeah. I love how you started to say that this was fun. I can only imagine new listeners to a podcast listening about fun ideas, and we're talking about ASML selling a machine to TSMC as a fun idea. But I mean,
yeah, I'm a nerd. I'm a dividend growth investor nerd. That's clear.
Yeah, but look, it's clear ASML have such monopoly, like 380 million for a machine that a customer did not want to buy, but has to buy to keep up.
And it is interesting because the outgoing CEO at the time, he had like such a fireside chat, and he was talking about it like okay, we could effectively charge whatever we want, but we don't want to do it because we will alienate our customers and we'll create a higher incentive for them to start maybe investing in other potential competitors. Yeah, so they always try to be at this equilibrium of having a proper margin, but at the same time not ruining the business case of the customer. So there's kind of a win-win, and there's not enough of an incentive for them to start doing, because this is the history of ASML, right? Where Intel and a few of these companies, they invested in ASML like somewhere in the first decade of this century. They invested in them because they saw the future and the potential for that reason as well. So I think ASML is trying to prevent that those companies start to do it elsewhere now.
Yeah, and it makes sense. I mean, you could charge what you want, but that's a short-term gain, and
exactly.
Eventually innovation will take over and people invest in other areas. So
they're
doing a good job at that, I have to say. They're doing a good job.
I would say so as well. Yeah.
Okay, our favorite part of the show: dividend announcements. What hikes have there been?
Well, this one's so interesting. United Healthcare hiked the dividend by 11.7% to $8.40. And why is this so interesting? I saw a tweet this week on Twitter about a guy living in Florida getting a new offer for his healthcare, and he needs to pay $3,000 a month to cover his family. He has too much income to, be eligible to Obamacare. He's too young for Medicare. $3,000 for the family. This is insane. I can live on this easily in Poland, including housing, food, doing whatever I want effectively that makes me happy, plus healthcare. Now, I know we don't have the best healthcare system in the world, but still, the healthcare system, the healthcare here is good enough. So you can you can live a life for that money, what he needs to pay for a single month in premium. And then we have United Healthcare hiking the dividend by 11.7%. So for me, when I see this, I don't understand why Americans are even accepting these healthcare prices. And that's why I don't understand how United Healthcare can get away with it, and and how they could grow the dividend still for the next 20 years.
Yeah.
Yeah, I don't understand that. I totally don't understand this weirdness in society there, that they accept this, that they accept such healthcare costs. I really don't understand it.
Maybe they're looking at the Irish healthcare system because we don't have a good reputation. I have to say, it's not
Yeah.
the it, our healthcare system resembles more of a third world country than a first world, and that's not to offend anyone. That's just
Yeah.
the reality of the situation here. It's not really good. So maybe by paying for it, do you get a better system? I don't know. I don't know how good the American system is.
If you go to the Netherlands, you have compared to that, you have a really affordable healthcare system of I would say, pretty high quality, and Germany as well.
Yeah.
So this is just bizarre. This is really bizarre, and of course, it has to do with drug pricing, but it has to do with the whole system there. Yeah, it's the entire system, and citizens just accept it. Why don't they start voting for? I know you have two parties there. There's kind of a culture war going on, but create your party to fight just the healthcare system or whatever it is. Yeah,
Yeah.
this is insane.
It's a lot of money. Hey, imagine how much you'd have to make in dividends a year just to cover
Your healthcare,
not even
yeah.
healthcare, your whole living expense. Like your living
Ah,
expenses over there must be upwards of 10K. Must be if your
yeah,
healthcare is 3,000.
yeah. No, it's insane for me. It's insane for me, really. Talking about driving people into poverty, and we see these documentaries about America, right, where you
Yeah.
see about the healthcare system and such, and that we see it also on social media, where people are sometimes just keeping a job because the company provides healthcare benefits.
Yeah.
Yeah, this is insane. It's insane.
Let's move on to better news.
Yeah,
ARE announced a 2.4% hike and now paying $1.30 quarterly. They usually do a couple of hikes a year, so it's
yeah.
not this in isolation. The 5-year CAGR is around 5% as well. So
Yeah, and Alexandria Real Estate is often coined by some of our followers as one of the best real estate investment trusts, right? So it's nice to see these hikes coming in. I mean, I've never really went deep into it. Maybe I should do a dividend stock card about it for our premium subscribers. But very interesting one, and maybe I should dive deeper into it. But then the next one, and I have looked into this one time, is Essential Properties Realty Trust. Also hiked the dividend again, now also 4.3 dividend. The hike was 1.8%. Also a relatively interesting real estate investment trust. And if you look at these and you look at Realty Income and Agree Realty, these are all kind of solid real estate investment trusts, right? And they give a relatively nice risk and reward with a dividend yield around 5%. So
yeah.
yeah.
And remember, we're not really in a real estate friendly environment over the last while. So the lower dividend increases is not too much of a surprise to me.
Yeah.
So, and then our last one is Lowe's, ticker symbol LOW. They will hike their dividend from by 4.5% to $1.15, and that is a respectable 63 consecutive years of dividend increases. Quite nice.
This is interesting because this is one of those companies that I wouldn't mind having in my portfolio. So I'm thinking about these three, and maybe I should really sit down one time. I'm thinking about Lowe's, Home Depot, or Hornbach, because Hornbach has also a solid dividend history here. And actually, it's a chain that I know, that I understand, and the commercials are really good, like for strong men. Yeah, and already since I know it for the last 20 years, I always prefer to go to Hornbach. We don't have one in proximity here, but I think Hornbach can still really take over a lot in Europe. They have so much growth potential all around Europe with their brand, with their products. So yeah, I would love to hear maybe also from one of the listeners that owns Hornbach. I don't know if we have any, but if you own Hornbach, please reach out to me. And what do you feel about the stock? What are the pros? What are the risks? And we have a stock card about it. So I did do some analysis about it already. But I haven't been following the stock deeply over a lot of years to have a really good feeling for
Yeah.
it. So if there is a follower that has it, owns it already for a few years, I would love to get in touch with that person.
Yeah. Yeah. But Lowe's does look interesting as well. I think financially it ticks all the boxes in terms of
Yes.
metrics, and even from I haven't done any proper calculation, but from a PE perspective, it looks actually quite close to valuation as well. So yeah, it looks quite interesting. But if you have a more conviction or affiliation with Hornbach, then stick with European. It might be the way to go. But I look forward to your analysis and maybe a stock card on Lowe's.
We have a stock card about it.
On Lowe's?
No, on Hornbach.
Okay.
Oh, Lowe's not. Okay.
No, on Lowe's not. And then we already know this. This is probably not news. This is old news. But 3M has been officially removed from the Dividend Aristocrat Index. So that was done on the 3rd of June. So no longer a Dividend Aristocrat.
Yep, it is like it is. It's a pity.
Yeah. Okay, 10 companies we would not like to own. I'm going to let you open the floor here, and I don't think anyone will be surprised. It's been, I'd say, a couple of episodes since you've mentioned this company's name. So come on, get it off your chest.
Yeah, no, this is IBM, of course. And we dedicated one time an episode to how to spot a bad company in the past, right? So I may look up the episode name and link it to the description here. And for me, IBM is really such a nice example because it's all about financial engineering. They did it a little bit less the last 2 years, but also I looked again at the last numbers and they had kind of somewhere a tax benefit, which is included in the numbers. But it's just financial engineering over the place. I think over the last decade, they had like 30 to 40% difference between GAAP and non-GAAP net income. So this 30-40% is actually what I call fooling you as an investor. Yeah, and this is very interesting because why are they doing that? Why are they doing this? Yeah, because investors are not stupid. The share price has not been rewarded all the time around this as well. So just take your investors serious. Stop with this non-GAAP shit, because when you see a decade of such financial engineering, you cannot say anymore these are one-offs. What you can say here is this is management. These are results of management actions. Yeah, and that's important, I think, for our listeners to know. Yes, there is sometimes that you say like, okay, for comparison reasons, but if you start to exclude all the time these kinds of things, there's nothing to compare anymore. Yeah, anyway. So then just look at the bottom line numbers, because management is just fooling you. Look, it's not only about the financial engineering, because you can say, okay, let's do it. I just take their earnings with a grain of salt, decline it with 40% or deduct it with 40%, and then I'll run with that number and see how it goes as long as that number is growing. But they missed the boat on the cloud.
Yeah.
We did one show, and I think it was the same show there, where we looked at each year's press release, and then it was every time a different technology that they were hyping, and a year later it wasn't even a mention about it anymore, right? Like whether it was cryptocurrency or the next Bitcoin, or it was the cloud, or it was AI with Watson. It was all time something. But they missed the boat on cloud. But what they did do, they bought Red Hat for a very expensive figure. And to ever become meaningful, it has to grow really a lot. And it is doing this. So Red Hat, it was a good acquisition, but at what price? They paid so much for this. And if I now look at the year-over-year results, I think that 1% growth, 3% constant currency, and this 1% had this tax benefit included. And then if you then look at the likes of Microsoft and Amazon that have also cloud businesses that grow with 20%, then look at IBM. Yeah. And of course, there's a good yield in return. The yield is much better than the Microsoft and the likes. But I mean, if you see this, I don't mind having a slow growing business where you get the yield in return, but then the financial engineering and the failure in decision making over time. You can say Red Hat is a good business in your portfolio, but at what price again? then who wants to own such business? I don't understand. And I know on FinTwit there are many people that have bought IBM. I'm probably the one most vocal against it here, because I see people making bull cases for it already for over a decade, and it's all the time the same, and all the time the same result. So yeah, that's my first one.
Yeah, the bull case. Look, I don't understand the bull case. You're probably hanging on to the coattails of AI. Maybe at this stage is probably where they're going. And Red Hat is obviously the crown jewel, even though the numbers are not too impactful on the overall top line of IBM. But dividend growth has been very, very slow over the last 5 years. You're looking at 2% CAGR. Look at the debt. Look at the debt on the balance sheet. It's been increasing since 2001. It was 47 billion. It's now 56 billion. So you're looking at 2.5 times equity there. It's just too high. I mean,
That was because of the share repurchases that they
Yes.
were doing, and then Warren Buffett jumped in, and I think he jumped out after a year already when he actually learned what he really bought.
Yeah, and they stopped buying back shares as soon as he sold. But yeah, it's look, as you said, financial engineering. I think people only invest in this because it's a dividend aristocrat with 60 odd years
Yes.
dividend increases. But
Yeah. But then you can buy a bond at the
Exactly.
moment for 4 or 5%.
Okay, I'll jump on to my first one, and it is Medical Properties Trust. And I remember this blew up all over Twitter at the time. I mentioned earlier, 2023. It's a tough environment for real estate investment trusts at the moment. It is a tough environment. We have interest rates that are fluctuating. Are we going to cut them? Are we not going to cut them? And they're relatively high compared to the past, and that puts them under pressure. So only the ones with the best balance sheets can survive, and they're the only ones that you should be looking at. On top of that, they had 18% of their assets in Stewart Healthcare, and Stewart Healthcare ran into a bit of trouble, couldn't afford their rent, which put a massive strain on Medical Property Trust balance sheet, on their income and what they could do. Eventually, it resulted in them having a high yield. Everybody was buying them. Then all of a sudden, they cut their dividend yield. They've got too much debt on their balance sheet. So, look, for me, it's just one that I'm glad I missed out. The jive missing out, I'm going to say. I know a lot of people, Chuck obviously has a position in them and he's happy to own them. But I just think in times when it's tough for a particular sector, you need to focus on the strongest ones in that sector. And I don't think Medical Property Trust falls into that. I think it became a little bit of a meme stock, even though technically it didn't, but it had that kind of a feeling to it. So with all that floating around it, I'm glad I stayed away from it. And honestly, I'd have no interest in even going back to that. I do believe actually though that management are trying to reduce their dependency on a single tenant, but I don't know how easy or how long that will take to do that. So for me, it's a clear stay away, and you're not going in my portfolio.
Yeah. But then on our Facebook group, there are quite some people that went into Medical Property Trust, and they've been earning quite some money with it. But I would say that was probably more value play than a dividend growth consideration, unless you think like, okay, hey, the cut is behind it, and from now the only way is up with the dividends. Yeah. Because it's I said that's also fair to look at it, right, from that point of view. But I think it's more still value investing than dividend growth investing, because usually when there's a dividend cut and the business doesn't look like really rosy, let's say, you wouldn't buy into it. It's then more like a deep value or something like that if you consider, because we also bought more Shell after the dividend cut. Yeah.
I mean, there's definitely money to be made there depending on the type of investor you are. It may have fallen so far, as you said, that it was deep value and your plan is to hold it and sell it at a particular price point. I have no issue with that. As a dividend growth investor, which is what I am, I want reliable, steady income over the long term. I don't want to be buying and selling companies. I've tried that. It doesn't work for me. I don't have the tolerance for it. I'm not very good at it, so I prefer to stick to what I'm good at. And if I look at it, even from a dividend perspective, there's just too much depth on that balance sheet for me, and it doesn't feel that safe. So for me, it's a clear stay away.
Okay, nice one. So the second one for me, I would like to talk about is Volkswagen.
Oh,
because Volkswagen is very interesting. Um, I mean, it's a strong brand over here in Europe, I guess also in America and other places. And Volkswagen, for people that don't know, it is of course a German car manufacturer. It has the Volkswagen Golf, Passat, and a few of those other cars. You see them all over the place here on the road. I think they still made a nice transition also to the electrification of their fleet. So more and more electric cars are coming out there. I see them driving around from time to time as well. Poland is not the first mover when it comes to electric cars, but they have some good incentives at the moment. So I see them more and more on the road. But the issue with me, and I'm now maybe calling out Volkswagen, but this applies effectively to every car company. This industry is very sensitive to the economic cycle. It's really boom and bust. Yeah, and that's the issue. In 2008, if the world shuts down financially, then who's buying a car at that moment? Yeah. The issue with such company is not so much that they can't prepare for it, but they have such a high operating costs. Yeah, because these factories are still there. Yeah, and if you want to produce one car, you still need to open it. Yeah, so there's a really, really high cost with debt servicing as well, even if you wouldn't sell a car. So that's the issue with Volkswagen. That's why the dividend is not sustainable. And if you look at the last 24 years, they had to cut the dividend in 2004, in 2010, and 2016. And the dividend cut in 2016 was quite a huge one. But the interesting fact here, if you can see through that, the dividend grew from 77 cents in 2000 to €9 right now. Yeah, that's more than a tenfold of your dividend income. So if you can zoom out and don't mind dividend cuts, there was a lot of dividend income to be made here with Volkswagen. But just for the fact that this kind of a boom and bust cycle, very sensitive to the economic cycle, I can't invest in car companies. And Volkswagen is a good example for me for that.
Yeah. Yeah. We had an episode, I think, with the Kleiner Capitalist about irregular dividend companies and companies that are known to cut the dividend but continue to grow over the long term. And Volkswagen would probably fit into one of those categories, I would say.
Yeah.
But in terms of, I suppose, you have to know what you own. I think it always goes back to that. But in terms of your goals, and it's probably similar to mine, it's stable income. And I think the theme that we've seen so far between the last two companies is the stability is not there, and that's just not in our
league. Yeah.
Nice one. So I'm going to move on to AT&T. Again, no surprise. Look, they've cut their dividend. Do you remember back in the days when we started our podcast, it was AT&T under 30. There was me. Every time it dipped under 30, there was people.
Call me a fool. AT&T under 30, call me a fool.
I'll be fool. And there were so many people buying it. And look, I held them as well. I held them even after the dividend cut for some time. They had that dividend. I think it's a similar story to IBM. They have this Dividend Aristocrat status. They also had a high yield, higher than Verizon, who was the main competitor in terms of the dividend growth investing world. And eventually it just got too much and they cut the dividend, which should not have been a surprise considering how highly leveraged their balance sheet is. But I think the fact that they were the Dividend Aristocrat and showed some sort of commitment to that gave them a little bit of leeway. But I think telecoms in general are hard to invest in for the long term. I think like car companies, they are quite cyclical. They can go through high periods of boom and bust. They are highly capital intensive. We've seen it with Vodafone. We've seen it with Orange. We've seen it with AT&T now that they can cut their dividends and be quite irregular. Verizon is probably an outlier here who have a stronger track record, even though the balance sheet is still not as strong as you would like. But yeah, for me, I think telecoms is one. If I'm looking at long-term dividend growth investments, I try and stay away from. I have invested in Orange in the past, but when they reach the bottom of the cycle, like I said earlier, with a clear point of where I want to sell them, and I did sell them at that point. But honestly, at the time, it just didn't fit my strategy, and I don't think I'll go down that route again for a very long time. I prefer to stick to boring, stable income, and AT&T. I don't think offer me that. They do have a high yield again. They are starting to increase it slowly, but there's always that risk with that balance sheet.
Yeah,
it's so fragile that another cut's just around the corner.
Interestingly, because then I have to talk about my stock on this list, which is KPN from the Netherlands. Yeah. So I know there are quite some Dutch dividend investors that are a fan of KPN. And I understand why, because they really have improved in their capital allocation strategy. They are now very clear about the dividends, that they want also a growing dividend, which was not always the case in the past. I mean, they had some hostile takeover bids from a Mexican guy, I remember, in the past and such. It was a mess, this stock. Now, stable management, I must say. Stable management with a clear dividend policy. So that's really in its favor. But to your point, these companies, they require so much capex to stay in the game. For instance, when there is again a new frequency, how is it? Frequency auction.
4G, 5G, 6G, 7G.
Whatever will come. Yeah. The government is specifically in countries in Europe, they want to earn all the money from it, and they don't want the industry necessarily to earn the money from it. Yeah, so it's not the most capitalistic friendly approach to it. So who's benefiting them from it? I see the Apples and the social media companies of this world benefiting from it. Google with YouTube. People can watch YouTube in the train. Yeah, really huge margins on this with the advertising income. But companies like KPN, what are they earning from it? Yeah, they have so much pressure on the pricing here. Consumers can also switch to others because of the governmental policies. So there are relatively low switching costs. So yeah, you pay effectively all this capex, but the other players in the industry benefit from it, like the tech companies. Then also, I always have a feeling that a company like KPN and also AT&T, they are really sensitive to technological disruption. I mean, now you have a guy called Elon Musk that puts a satellite in the sky. What if this becomes quick enough? Do we then still need broadband internet like that? Yeah. So these are kind of things that I always have in mind. And I know, of course, with the current technology, then these companies, they own it because they have all the sites with the antennas and everything. Yeah, they could be out of business overnight by a new technology coming in. Last but not least, and this is where I would like to return back to AT&T. Over time, right? So let's say KPN now has solid, better management, and they accept that they are a boring company. Probably the CEO is very boring, yeah. But then there come these managers, these career animals, like in AT&T. They surface up and they come into the board, and they feel then like, we can grow better than a return on 6 or 7% annually for our shareholders. We can do it like for 12%. Let's do this. Let's acquire, what was it, Warner Bros.
Warner.
Let's go into the streaming wars. Yeah, that's what we can do really well. We have the technology for it, and da-di-da-di-da. And before you know it, you find yourself as a shareholder being diversified by management. And that's always a risk that I see with these kind of slow, boring companies where dividend growth investors benefit from. Management comes in there with their ego and they want to turn this into a high growth story. Because why? They can say then at the cocktail party that they have been the best CEO ever. But what happens in reality, they diversify and and we have seen the cases over and over and over.
Yeah. Maybe their bonuses depend on the growth as well. So they want to increase their pay packet and try.
Yeah, but I think companies like KPN, they should be probably more founder-led, if possible, still after all those centuries. but where you just clearly articulate as a company, like, guys, expect from us 5% growth over the next 20 years annually, plus a 5% dividend. You get a 10% return. That's it. Be happy with it. We'll manage for this. You filter out all those investors that are in there for the short term or that want to make a quick buck. Just be clear in your communication, because that's what the business is made for. Yeah, and then you will get also the shareholders that you deserve.
Yeah, exactly. And a more stable business that doesn't go into areas that they have absolutely no clue about.
Exactly.
Okay, so my third company is Johnson and nah, I'm joking. I just want to see your face. It's Bayer. And look, mainly we spoke about this. We have an episode, the worst acquisition in history, where we spoke about Monsanto. So I'm not going to go into too deep detail here. But look, litigation is huge. I mean, it's my biggest learning over the my journey of this is to stay away from litigation, particularly big litigation like this. It never works well, particularly for a European company in America, because we just do not know how to handle it, how to navigate it, what to do. We're not Johnson and Johnson over here. We're just Europeans that live a different lifestyle. But yeah, look, buyers one I'd stay away from. Their free cash flow is all but deteriorating because of this litigation, which leaves no room for dividends, which led to a dividend cut. So I think for as long as they have Monsanto, and as long as they have this huge litigation battle, for me, it is a clear red flag to stay away from them. The frustrating part is away from Monsanto, they have a really nice business. And it could be a good option if they could ever spin off Monsanto and all the debt and all that. But it doesn't look like they're ever going to go down that route. But yeah, it's a shame. It's a European powerhouse. It has had a great reputation, but one acquisition, one manager, like you said, decided, yeah, let's buy this thing that sprays weeds and kills it, and we'll grow our business at 12%, has absolutely crucified the company. And for me, it's a no-go for as long as they have Monsanto.
Yeah, I still have a bit of Bayer, full disclosure, but I agree with everything you say.
Yeah. Don't buy into litigation.
Oh boy, no, no, don't buy into it. Okay, next question. Next. Okay, this is a section for later. Next company that I would like to talk about is Pfizer, because Pfizer is also in the dividend investment community, a company that many people own, and I would never want to own it. I mean, never ever. Yeah, okay, never have I ever. That's another story. But look, I just opened up their quarterly reports, and I just looked at the portfolio that they have, product portfolio of medicines, and I probably saw 70 to 80% of their products being in decline, yeah, between brackets year over year. So that's already saying like, oh boy, what's going on with their portfolio? Yeah. They came, of course, one of them or two of them were COVID related. So those ones I don't even consider, but that's already a bad sign. Yeah. But if you then look at it, I believe they made like 11 billion in net income or free cash flow in 2018. Now they make 5 billion. So I'm comparing now pre-COVID and post-COVID, which is insane. Now, question to you: what did they do with the cash that they got during that time?
I believe they paid down some debt. To be fair,
Yes.
I think they
Yes.
cleaned up their balance sheet as well, and there was an acquisition in there as well.
Yes. So they then acquired Segan again for 42 billion. But this feels a lot like Medtronic. Medtronic also did one of those acquisitions in 2016 or 2017, overpaid massively for it, for no impact to its free cash flow. This is what I'm afraid here with Pfizer, that it won the jackpot, it won the lottery, and did pay off some debt, but then leveraged up again to acquire a business which is really not contributing a lot to the bottom line as justified by the acquisition price.
Yeah.
So when you see this, half of the earnings 6 years, 7 years down the road, you see a product pipeline with existing products that is almost everything in decline. Is it really the yield then that you need to go into it for this company? Then I much rather have AbbVie, where they have a solid pipeline at the moment, but where the debt is high. That's why the yield is relatively high. But you see a management that's consistently paying down debt, and when there is an opportunity, they do some very small strategic transactions. I rather want to have something like AbbVie, but Pfizer, I really don't see why anyone wants to own it. I really don't see it, and I know that probably many people that are listening have it in their portfolio. But for me, it's kind of a business. Like, I mean, I'm a dividend growth investor. I'm not a dividend investor, and those are two different
Yeah, yeah, 100%.
styles.
I remember way back, it must be pre-COVID. It was definitely pre-COVID, and we had an episode on Pfizer before it took off, really, with the COVID vaccines. And I remember you speaking about the pipeline and how weak the pipeline is and how much of a concern that was. And that narrative didn't change. They ran into COVID. Yes, that gave them a bump unexpectedly. I think everyone believed at the time that that was there to stay.
Yeah,
Certainly I did as well. Nobody was able to predict what was going to happen with the world and how COVID almost all but fizzled out nearly. But if we still had COVID and we still had, they would probably be in a better position. And
yeah,
maybe they banked on that, and that's why they paid down some debt and did their acquisition. But again, the pipeline hasn't changed, and
yeah,
they haven't invested into that pipeline from what I can see. And yeah, it's a clear stay away for me as well. Actually, you had already picked them. They would have been in my list, or only for you had them, and
yeah.
I just can't.
Yeah, I think we need to watch out with what we say because you use the term pipeline
Yes,
versus what I mentioned about their product portfolio. Those are two different things.
yes,
So their pipeline is indeed neither strong, and their product portfolio is very weak. Yes, so it's a combination of the. Why I'm saying because there are some analysts that are really giving Pfizer a buy rating at the moment because of their pipeline. I just don't see that in the pipeline. I'm not a scientist, so it's harder for me a bit
yes,
to judge. Maybe the analysts are better in that, but honestly, I usually suspect that the analyst is just looking at the share price, draws a line and things like, that can be like this could be $40 instead of $29. Yeah. So that would be like, I don't know, 15% annual return from here. Let's give the buy rating. Yeah.
yeah.
Sometimes I have a feeling that it's that simple that analysts are doing.
Yeah, and I've spoke to you on this show about my feelings on judging pipelines. I'm not a scientist,
Yeah.
and it's hard to get a feeling of what they actually mean. I'm only going by what you read online.
Yeah.
But yeah, it's for me, stay away from Pfizer. There's
Yes.
definitely better options in that field. Okay, my one. We actually got asked the question last week, and we were reminded again this week to do that. And that is, what would we sell from each other's portfolio? This inspired my next answer, and it is BHP Billiton. And look, the reason is it is a commodity. It's basically commodity dependent. It is highly fluctuates on iron ore. I know they have copper and other parts of the business, but iron ore is the biggest part of their business. Like we said with AT&T and a couple of other businesses, they are highly capex intensive. So this puts a strain on the financials, particularly when that cycle is low. And we've got this irregular dividend, so it's not predictable. It doesn't give me that predictable income stream. So yeah, that's pretty much why I look. I think I've learned over the last years is don't be chasing high yields. So this typically would have been a company I probably would have bought, particularly as the yields were high, and look for more stable income because it'll work out better for me long term. So that's one of the reasons I'd sell them from your portfolio, buddy.
Should I justify why I have them?
Of course. Go.
Okay, good. I bought BHP Billiton. I need, let me quickly check, but I bought them kind of at the bottom or at a very low point in the cycle. Yeah. So with that, I looked at it from, okay, there's a floor of the dividend in here. And 90% of my portfolio is dividend growth. This falls in the other 10% where it isn't. This is a dividend stock, not a dividend growth stock for that reason. And I have the same with Rio Tinto. So if I look at BHP, and bear with me, it's also a small, relatively small position. And the same applies to Rio Tinto. Yeah, I bought them at an average price of, let's say, $37 at the time, and I know that I bought even at $23 when I bought into this position. It's now around $58. So I've never had a feeling of selling them because for me there's a dividend floor in it, and the same for Rio Tinto. But I agree entirely with you. If you want to have 100% pure dividend growth, which I actually also want here, then it probably doesn't fit in the portfolio. But I just have Rio Tinto and BHP because I wanted to be in the materials sector. but I have to accept with that this is not that this is fluctuating in dividends over time.
Yeah. Yeah.
So
No,
that's the only reason. But I know why I own it, and I know that I have two stocks in my portfolio that will cut their dividends in such cycles. I know this.
yeah. And I think we have to put a disclaimer in with the stocks that we're picking. Some of them have a place in portfolios, but not a dividend growth portfolio. I think that's the key difference. And I think you hit the nail on the head. If you have a portfolio that's diversified and you have a percentage that is just on other stocks, perfectly. But my focus is dividend growth, particularly because I'm still in this accumulation phase, still trying to build up that portfolio, beat that 100K mark. I was so close to it when we had that little run up and it's pulled back. But yeah, look, it's I can understand why you have it, and having a dividend floor is good, but you have to time the market and buy it at the low part of its cycle, which is difficult to do.
Yes, that is.
Yeah.
Okay, hey, going from here, we haven't spoken about one industry that people also often know us for, because I've got this iconic T-shirt with "Bankers are wankers" on it. So I have to talk about a bank, and it's such a pity that the violation tracker website was down before my preparation of the podcast, because I wanted to show all the fines that they have received. But this is Wells Fargo. Remember this fraud case that they had where they created fake accounts without the client knowing they were creating accounts for them, and then charging them interest rates on it. And then when they didn't pay it down, they would go to their house and try to claim their assets. Like,
Man.
how bad this is. So then later in 2022, they also got another 3.7 billion fine for widespread mismanagement, including repeatedly misapplying loan payments, wrongly foreclosing homes, and illegally repossessing vehicles. Yeah, I mean, and this company still exists. They are considered by American court a repeat offender. They cut the dividend by 80% in 2022. And I want to call out here, this was a Warren Buffett stock. And when the Senate hearings and everything, where the CEOs were staying coming up, Warren Buffett was quiet. He was not talking about Wells Fargo at all. And this is where you see the dark side sometimes of Warren Buffett, because we all like to hug him, and he talks about management and that you need to trust it and such. Why he never called out Wells Fargo? He is okay to praise Coca-Cola, but why isn't he able to shame Wells Fargo for what they were doing? That's where I feel like that Warren Buffett, we all love the guy, but he has also a hypocrite side, and that's for me very much demonstrated with Wells Fargo.
Yeah, yes. Look, sometimes you can't be that successful and make that much money and be squeaky clean all the time. So we do like to comment a lot on Warren Buffett, but not every move of his is brilliant and good and the right.
No, but here it's even about being hypocrite, because he's talking about management. He's talking effectively a lot about doing proper business and everything. And then he had Wells. I don't know if he still owns it, something, but he was a Wells Fargo owner at the time.
Yeah,
and it just didn't rhyme with his whole investment philosophy.
Yeah, but he's also there to make money, so he might have skipped that one, just give it a pass. But let's stay on banks, because my last one was Irish banks, and I specifically said Irish banks here because I don't want to paint all banks with the same brush. We've had a couple of Canadian friends on here who have convinced us, or tried to convince us, that the Canadian banks are different, and they do seem that way. You have to give them props. But Irish banks,
if there's any time ever, I would
have
look
to be
at
Canadian.
I could not look at Dutch banks. I could not look at the American ones, but I could at least that would be a corner, if you put a gun on my head, where I would start looking then.
Yeah, and I put Irish banks in that, and they're not particularly known for the dividend growth. They have paid dividends, they've cut them again, they've paid dividends, they've cut them again, and they are now paying dividends again because times are rosy for them. But I mean, aside from the irregular dividends, you talk about scandals. Irish banks have been well known for their scandals. Only recently, maybe last year, the year before, there was this huge tracker scandal
where people are overcharging, making money. And both of our biggest banks that are state-owned or partially state-owned, by the way, had massive fines of over 100 million because of what they're doing in terms of people tracker mortgages. And that's just one example. You go back to 2008 when there was a huge financial crash. They had to be bailed out. Who bailed them out? The people. And they still paid all their bonuses. They got all their bonuses. And like you,
But
like,
it's insane. I mean, Dutch banks at the moment, do you know what they are giving you as an interest rate on the savings account?
probably less than 1%.
Yeah. It's criminal. It's really criminal because they get to they get to charge 4 or 5% now with the interest rates, right? So they have such a high they're just getting all the profits, and it just shows there's even too less competition.
Yeah,
because customers are not even they hardly have an option. What customers can do now is go to foreign banks that are offering this, but people have been burned by Iceland, iSafe at the time, right? So, but it's just criminal. It's really criminal.
we have a lot of gaps in Europe, and one is definitely the banking system, because we don't generally have a truly pan-European banking system.
No.
Banks, of course, can go into one country or another, but they don't tend to. We had KBC here for a while, and they've left because the profit wasn't there for them, and it just leaves a monopoly or a duopoly on a couple of banks that can make all the rules, do what they want, screw the people over, and sit back with their fat bonuses. So for me, banks, but particularly Irish banks, are in no.
And then you have fund managers that are working in the banking system applying ESG rules. I mean, come on, guys, come on. Yeah, it's impossible for me to think about this. Yeah, so ESG is for me, therefore, one of the biggest scams that exists. Yeah, really, it's so hypocrite. The ESG, it's so hypocrite.
People should just have a look at the violation tracker, as you said. You'd be surprised who's on that.
Exactly. But the number of women in the board, really, if that's what we need to focus on, but we continue having all these kind of scams all around there, guys. I mean, and what is from one side even annoying because of all of this, you see that certain stocks are not being purchased anymore. Which puts a cap on their multiple, which is good for us because we get better dividend income. But then I'm thinking like, but wait a second, I'm also getting later a pension, which and that is based on what people are investing in right now. I want them to invest in big oil. I want them to invest in companies with proper management in there, which may be not so fancy to invest in right now because of the news and whatever, or because of the politics. But then companies continue to invest in banks. I mean, like, this is the biggest hypocrite thing that exists in the world today, and I hope this will go away one time again.
Yeah. Okay, so there you have it. 10 stocks that we would not want to own in our portfolio. Actually, I'd love to hear what are we missing, what companies should be on this list. So maybe drop us. We might put that in the question on Spotify, and we'll see what list of companies we get. Well, let's go on to our listeners' questions. And we got an email from Fabian, and I'm going to direct this one to you because it's mainly about Hershey's. And I don't know if you had time to read that, but he has a nice paragraph link about Hershey's, about commodity prices, how they're linked to commodity prices, and the effect that has on it. The questions he has asked us too. How much time do you usually take to form a decision based on journalistic information like what he provided to us? What does your thought process look like there?
Like journalistic information, you mean like the news?
Yeah, or from analysts.
Or from not a lot. No. I look at my analysis and then I check the news to see if there's something I missed. Because, for instance, not every company is transparent about what's going on, or maybe your information's out of date. If you now look at the annual report and the quarterly report, there may have happened something yesterday. So usually I then Google, check a little bit around me what's going on. Sometimes just on social media, on Twitter, searching for the company, you will quickly spot if there's something that you missed. So I don't spend a lot of time on that. It's really that, maybe 20 minutes. But then if I find something, then I spend more time. of course. But things that I don't care about is like analyst ratings. I really don't look at those. But what could trigger me is, for instance, seeing that the company was fined for something like that, that there's litigation going on. These kinds of the things are things that you can discover. And yeah, but I don't spend a lot of time on that. I just really spend time on more like reading the annual reports, understanding the financial statements, discovering their products. So what I often do is I go to, not to the investor relations website, but to their website and understand like, okay, what products are they selling?
Yeah.
For one company, it's easier than for the other, right? But I want to get a feeling for that. So
yeah. But let's say we know cacao is their biggest input and there's a shortage of this and they can't get a hold of this, the cost is too high. And you're reading these articles. Do you pay more attention to those type of articles?
No. I need to understand what's driving the profits. But I know about the cacao prices, and then I look at what the company is doing. It's hedging, and then I look at my wife, and she would eat chocolate no matter what. So, yeah,
okay,
yeah, and with the cacao prices, by the way, we do have an issue at the moment because we have El Nino, we have climate change, so it becomes harder to grow crops. Yeah. This applies to cacao, this applies to coffee beans, this applies to a lot of our food chain that we're talking about. So there's generally a risk in this. But I also, I also take those things a little bit of a grain of salt when it comes to the day-to-day pricing, because companies hedge against it. And if I would see that Hershey doesn't hedge against it, I would probably don't want to own it.
Okay, so taking that into consideration, and that leads on to the second question quite nicely. How do you account for this volatility? Let's say that the hedging is getting less, which I believe Fabian is saying is happening, right? So how do you account for this when you're doing your dividend discount or discounted cash flow model?
I can ask for a higher desired return.
So you increase
instead of instead of 10%, I may want to have 12.5% or 15%. But honestly, I know that people look at cacao prices a lot, but for Hershey, I don't look at it so much. Yeah. So I don't know why people are so afraid of the cacao price for Hershey. If you just look also the contribution of this as an input factor to the I understand it's chocolate that they sell, but the input factor is not that big. What I worry more about with Hershey's is competition from people like Mr. Beast that are more and more getting shelf space near the casas in America. And how I hear my son talking about the chocolate when he sees it in the shop and has no issue paying €5 for it. That's why I'm more concerned about the competitiveness, not so much about the input price.
I have to say, you spoke of Mr. Beast there. I spent a half a day sitting down with my son downstairs and watching his YouTube. Just let him watch what he's watching. And Mr. Beast he does some incredible stuff, man.
I think he's a legend. He's a genius.
His videos are so compelling, and the amount of money this guy has. So the video I watched, it was an hour long.
Yeah.
Watched the whole hour with my son. And he got two random people that didn't know each other, stuck them in the wilderness with nothing. Yeah. They had their clothes on them. They had nothing. Yeah. They had to survive. But every day they survived, they got 10,000.
Yeah.
Right. And then they could go home with whatever they want. And the money was dropped down from parachutes. Yeah. They were using that parachute to build tents, to build boats. It was it was incredible. I was sitting there watching going, how much money does he have, first of all? But this is incredible content. And I was even glued to it. But yeah, that's
he did also the famous Squid Game episode.
Yeah, I seen that as well.
No, I think this guy is really, really good in doing business. Really, really smart. Yeah. I mean, kudos to him. I think I'm not surprised. He's a great example, and I've been watching as well. And you know what? He's one of those YouTubers that's actually good for kids.
Yes.
What I'm trying to say, because he does it in a funny way, but he also he really demonstrates like giving back to society when needed, what it means to be a good person. He's not the one with the bling bling Ferraris and everything in the sense of showing off. No, if anything, he's giving a Ferrari to someone. Yeah. So Good. Yeah.
Good as them. Anyway, Thomas has reminded us that you need to look at my portfolio. I gave my one earlier, but I might give another one.
Yes.
You need to look at my portfolio, and what would you kick out of it?
So I would probably never buy something like Blackstone, or mainly Blackstone, but also Main Street Capital. This is a BDC.
Yes.
Yes, I'm not into BDCs, so I will probably also throw out Main Street Capital. And then I see some other stuffs that I'm just not familiar with. Yeah, so some of those investment trusts that I'm just not familiar with, but I can't just look at it. But if anything, I would throw out Main Street Capital.
Yeah, and that's part of my high yield portfolio. I think that's around 15%, where I use this income factory approach with that. And I kind of guessed you're going to pick those. So there's a couple there. There's Biopharma Credit, there's New City High Yield Fund, and Main Street Capital. So I kind of guessed that. Blackstone, I'm surprised about, because it's quite similar to BlackRock. But
I wouldn't buy them both, probably. And although I see the and this will still stay for decades, is index fund investing. But I have a feeling with BlackRock and Blackstone that we haven't seen a proper recession for a long time, because the banks are effectively printing everything. And I don't think, and then you can be fooled because of a 15-year bull run, effectively, with a COVID in between, of course, but you can get fooled a little bit by the strength of the business. That's mainly where my concern comes with these two companies. I would like to see them pressure tested in a real crisis that has an impact really on the consumer for longer term. Yeah, where for instance, central bank cannot bail us out easily.
Nice one. And then looking at yours, I picked one that wasn't in your dividend growth. So I'm going to try pick one that's dividend growth oriented, that I know is in that. It's quite difficult because the top 20 companies are quite good, but it's probably going to be in around Cbus or Starbucks. And purely, I don't like Starbucks. We've discussed this before. And look, I think their growth is under pressure. The brand is strong, but their succession planning has never gone to plan. And there's lots of talks with that. So Starbucks is one I would never buy, and Cbus as well. I think real estate in Europe is quite hard. And they had a dividend cut as well, but you have conviction in them. But
they cut the dividend from 99 cents to 90 cents. So they offered like almost a 10% yield to me. Plus, they are having supermarket chains as an asset. So, but I get why you mean it. I get why you say it. For me, it's a high yield investment, like what you had with Main Street.
Pepsi also scares me with the high payout ratio and with their cash flow. It also scares me. But overall, strong portfolio. Simon has asked us about something that he's been struggling with, and that is waiting. So he's struggling with patience, basically. He is struggling to wait for his limit orders to execute. What do you think?
I use this as well, limit orders. I use it for my watch list. So every time, also with the newsletter, I put in what I have on my watch list. I put there the stocks in there at that price, and they may not be triggered. So what I then do is, of course, I still need to buy that week, so I may pay higher and just put a market order in. But I think he's also talking about the ex-dividend date that is then approaching. So what will you do? So I don't look at dividend payments in terms of buying. I ignore them, because then I start to time a little bit the market. I then just take it on the chin that I will miss out one dividend payment in the next 30 years of my holding period, and I'm okay with that.
I won't lie. I think I tend to buy more European companies around March and April, when ex-dividend date is close. I'm going to buy them anyway, but I tend to buy them because when it gets to November, I'm probably like, wait a while, so I'll buy more American
Yeah.
companies.
But he's asking here also, so have you ever executed a trade above your ideal price quickly before the ex-dividend date? No, not because of the ex-dividend date, but I have done it above my ideal price just because the month is ending, and I really want to stick to dollar cost averaging the money into the account, money into the portfolio each month. So yeah, for that point of view, yes.
Alexandros has asked us, do you know what happens to the voting rights of the shares that are bundled into ETFs? Do the ETF companies somehow exercise these rights without our knowledge? Good question.
So I've been looking into this, and I understood some of them they do vote, but I find this a very tricky situation, because how can the ETF company as an institutional investor know what we find important? Yeah, if anything, I would like them to be so this is my opinion, right? I think that if they are voting, for at a company shareholders meeting, I want them to have a full disclosure in their investment in their investors toolkit or something like this, about what their position is on political issues or whatever it is, right? Because I wouldn't like that the ETF provider, for instance, if I own Shell, that the ETF provider is going to take a stance on the green stuff and everything, right? Like build more windmills. I think so. In my opinion, companies like BlackRock should entirely withhold from voting, but with that also prevent being at a certain percentage in any company, which is hard. I think as more and more money goes into index funds, we will get this issue that at a certain moment, index funds may become such a large shareholder that they maybe even are triggered to do something with it. Yeah. But I think they should always withhold from voting. That's my thinking, unless it's 100% clear, and they should probably put it in the title of the index fund, even that what their position is for this.
Okay. Yedia has asked us, are we familiar with the idea behind the income factory, and what do we think of it? I alluded to it earlier in the show. I have read it. I have a portion of my portfolio assigned to those principles. It's a little bit harder because it's US based, so I certainly can't, as a European, buy some of the companies or CEFs that is touted in that book. But I do try and do that in terms of investment trusts. So similar approach, just different instruments that I'm using. But I think there's definitely a place for it. It's not my full portfolio. I mean, essentially, it's just buying by yielding and creating your own dividend growth is essentially what you're doing. We have tried to get in contact with Steve, the author of this book, to come onto the show. I would love for him to come onto the show to talk about this in a little bit more detail. So if any of our listeners know how to get in contact with him, or if he
I've been in contact with him, right? On Seeking Alpha.
Has he come back to you?
Yes, he replied that he would like to, and then I asked him for a date, and I'm still waiting for an answer, so I should follow up with him.
Okay, perfect. I didn't know you got a reply, so hopefully we can get Stephen on the show. He'd be an awesome.
Yeah, it would be very nice.
Lewis has asked us two questions. The first question is, your portfolio has a big number, not enough to quit working, but you start to feel freedom. Because of that, you don't allow some things at work that for a few years you didn't think about. How do you convince yourself to keep going?
So I'm exactly in this situation. Yeah. But I never had that the company didn't allow for some things. I just work, I guess, at a company where I don't have that situation. So that's what I can't relate to. Yes, I just work at a company where they really, are, I guess, happy with me, and I'm happy with them. So this is a really, really hard one. What I can tell you is that I've got, of course, this FU money, what our guest ex-Berliner last week said. I do have this. But it actually created even a better environment for me, because having FU money doesn't mean you need to be rude at work, right? It just makes me more convinced about going for something that is maybe against the common perception or common thought. So I find it easier to challenge ideas, but you can do this with respect, and such. So, but look, if you're really at that place where you don't like your work anymore and such, right? Leave the company, go somewhere
Yeah.
else.
You don't need to be an investor to be stuck in a place you don't like. There's plenty of places to work, in
Yeah,
my opinion.
exactly. And if you're, let's say, at 60 or 70%, maybe you can go work at a Starbucks if it's nice. You get to meet people all day long.
I can tell you, working in a coffee shop is very rewarding. You do get to meet people that want to come in and chat, and you learn so much.
Yeah, exactly.
Okay. And the second part of this question sounds like a typical Irish question, actually, but I'll ask it. He says he pays big taxes, but they would be much bigger if he didn't use some financial instruments which they have in Spain, such as mutual funds, retirement funds, etc. So, would you quit putting money in mutual fund in order to invest somewhere else with better returns over the years, knowing you'll pay much more to the taxman, or would you continue with your actual plan?
I think I can't answer this question. I would really need to do the math. I would really need to sit down, do the math, and I miss a few input parameters here. I would effectively put it over the next 20 years, and I would just look at what the tax impact is and everything, and then just look at which comes at a better outcome.
Okay, Mike has asked us about your discounted cash flow model. Why don't you inverse discounted cash flow?
Because I'm totally fine with how I use it right now. So I mean, this is all about, there are like hundreds ways that you can value things, and at a certain moment you just get used to something and it becomes your preference, and that's really what it is about. I could use inverse as well, but I just never got used to it, and I prefer the other way of doing it.
Okay, Richard has asked us, theoretically, you're retiring in 1 year. What strategy changes do you apply to your portfolio? I'm thinking here that I will not apply any drastic strategy changes to my portfolio. I'm trying to build a dividend income, right? A dividend growth income that's paying me money every month. And when I hit retirement, I want that cash flow every month. So I can't see myself making any drastic changes. And honestly, no, I don't think so.
So I can tell you what I was talking to you before the show about. So, Richard, I may be, I don't know, 3, 4, 2 years away before that. So, and why I'm saying like this, because of what is coming now. I started to make a list for myself. Which big expenses do I have coming up in the next 10 years? I know that I will need a new car. And I know that I need to do probably a big investment around the house on something. Yeah. So with that, I made this list, and I'm going to buy a car now, like in the upcoming year. I'm bringing that now, so that I know that over the next 10 years, I have a car to drive. Yeah. Provided that doesn't break down, but that's some for outside of the warranty period. But the same with the renovation. I may do that now. Yeah, and then not needing to wait. It's actually not really a renovation even, but there's a big expense there. And then I will refill again also my savings account with a certain amount of money and everything. So that's more what I started thinking about now at this moment in time. Like, okay, I have the money on my account. I can do it now. I can also do it during retirement, but then it may be harder to refill as easy as it's while I'm having a job, because when you're at retirement, I may be doing it at a slim retirement that is exactly covering my costs. Yeah. And there's of course a reservation in there for future payments.
Yeah.
Here, but I can just say like, okay, you know what? I may retire a year later because I take all those costs now a little bit forward, and then I refill it again and then do it. And I know that at least the next 4 or 5 years, I should not have those high expenditures coming up. And I can then let the dividend just grow to that position that it will be easier for me again. So that's why I'm thinking now. It's maybe not entirely answering the question, but it is something that I'm considering about, but because it means that I may not be able to invest that much in the next coming year as I was used to do, because I want to refill quicker my savings account.
It's a good plan. We spoke offline about it. I think it's very sensible actually plan, and it's good actually that you're so close to that point and your thoughts and your thinking of that, because it's something that when you're 10 years out, it's hard to be in that mindset. Theoretically, you can give an answer, but when you're living
Yeah.
it, it's good from experience point of view. And David has asked us about your 2023 annual report.
Oh man,
Where is
yeah.
it?
I've got the numbers in a G sheet, but I haven't written it, and I don't see where at the moment I can find the time. So this is one of those examples where I overpromise and underdeliver, but I mean I'm breaking a trend, which is really hard for me. So I'm going on a vacation soon. Usually I have some time to read a book. Maybe I have a time to also spend a few hours writing the report.
Cool. I look forward to it if you get a chance. Le Collector de Dividendes has asked us about an investment trust called TR Properties, and ticker symbol TRY. It has 13 years of dividend growth. It focuses on UK and EU real estate and has pretty decent yield of 4.6%. Curious to get our views, and full disclosure, he owns this company.
Yeah.
It's been on my list. It's been on my radar. Looking at this as a way, so I spoke to you about CBUS earlier. I wouldn't invest in CBUS, and I had a bit of experience with Vonovia and then sold out of them, right? Because I think European real estate is difficult. It's not your typical REITs as we know in America, so it is quite difficult to understand. And the landscape within Europe, unless you know that area, it can be hard to have a really good understanding in terms of, yes, I can read something about it, but if I want to be more confident in my investment, you want to know a lot about that. But I think this is a good way to do that. And they do have a strong portfolio from what I looked at. I also listened to their fund manager, and I think his name, this is off the top of my head, so forgive me if I get this wrong, but I think his name is Marcus Ferry Mudge or something. I think it's definitely Marcus anyway. He was on a podcast that I've mentioned before, the Moneymakers podcast. And I did like his strategy. I did like the way he talked about it. Obviously, dividends is quite high that, but his knowledge of each market was quite extensive. And obviously, he's not on his own. He has people working for him that helps them, but it is one that I am interested in. It's just not, I haven't looked into them at the moment to make a purchase, but it is definitely on my watch list. So thank you for reminding me actually to look at that, because it's been on my list for, I'd say, 6 to 8 months.
Nice.
Okay, Dennis has asked us about Intel. They cut the dividend last year and now trading at a multi-year low. Is this the moment to buy them?
Yeah, it's not only Dennis, also Sebastian asked about this, right? But again, for me, this is a value play. I own them, but I own a small position, and I will keep it like there because there's too much risk associated to it. The CEO, Pat Gelsinger, great engineer, and having a long-term focus, but he has been under-delivering compared to what he was promising over the last 2 years, and that's worrying me. And if I see that, I will definitely not increase my position. I'm keeping it for now because I still think that Intel has a lot to do there because of the geopolitics that's happening, the CHIPS Act. I mean, effectively, politicians are bailing out Intel. They want Intel to be successful, not all the money flow to Taiwan and China and everything. So that's why I'm still in it. Otherwise, I may have been out of it. And usually, I say don't buy a business that depends on the government. But in Intel, it's kind of where this rule is justified because I have an exception.
I was actually surprised with this question. I didn't realize they had dropped so much in share price. The last time I looked at Intel, they were trading above $45. So to see them down on 30, I was surprised. Look, I think you're right about Pat. I think we give him a lot of credit. He does talk a good game. I've yet to see him deliver 100% on what he's promised. So yeah, I stepped away from Intel. I'm quite happy. As you can see, I don't even look at them anymore. I'm quite happy.
Yeah.
I'm away from them. I seen an interesting graphic actually yesterday morning on X. Around the market share in that, and you can clearly see Intel's is declining at a rapid rate while our competitors are getting stronger. So look, they have a lot of work to do. it is a big industry. It's a growing industry. We know there's a lot of potential there, but the competitors seem to be doing it better. That scares me. So no, it's not a time as a dividend growth investor. It's not a time for me to invest in these. Okay, Pedro has asked us about Insperity. I don't know if you know anything about that company.
I had to look it up the other day because someone shared with me that it's their biggest position. But honestly, I didn't go deep into it. But it triggered my interest, and I've put it on my list to look into it. But honestly, I haven't looked into it, Pedro. Maybe reach out to me on wherever it is, Facebook or Twitter, and let's exchange some thoughts on this. Yeah, and then maybe next time I can be in a position to answer about it.
Okay, and then Mayak has asked us about companies like Accenture and MSCI.
So Accenture is very interesting because I've been working in the consultancy industry, and I always felt like consultancy is uninvestable because of the cycles. Again, yeah, who needs a consultant when you need to save money as such? But there is something to Accenture, which is really, this company is really top notch. They're really. I know we when you work in a company, in a corporate, you will always complain about your consultancy firms, and you will complain also about Accenture. But the question is it always fair? If you start not looking from that point of view, but you start to think from a consultancy point of view, and you're within the consultants, then for me, Accenture, it has a much better consultancy business than, for instance, IBM or the French company Capgemini. Yeah, because they just look at how they operate. You see it when you work and you talk with the people from Accenture. They are just they have a much better culture, I would say, and business model internally. So Accenture, I think, is one of the strongest there. And I almost bought it one time, but then it became too much valued for me.
Yeah. And if you think about these two types of companies, the first thing I think about is free cash flow. They are monsters at generating free cash flow. Their free cash flow growth is insane, over 5%. Their free cash flow margins are insane. I actually read a book last year, it's called The Quality or The Intelligent Quality Investor. And these two types of companies fit that bill. I think they're low yielding. Accenture is an Irish company, by the way, so it does interest me. But I find those companies hard to analyze and to really understand what's going to drive growth, or just to get a real feel of that company. MSCI, on the other hand, I can understand that a little bit better, and it would be a company I'm interested in, but the yield is quite low. But I believe that dividend growth rate of both companies is quite high as well, nearly double digits. The last time I looked, it could be wrong. But the yield was quite low on MSCI, which is why I stayed away. But yeah, I think quality businesses all around, strong cash flow generation. Good to have in a portfolio at the right price, I would say.
Exactly.
Awesome. That is the last question. Thanks so much to everyone for your questions. As always, we do appreciate them. And we hope you enjoyed this episode of 10 stocks or 11 stocks, including GameStop, that we don't want to own in our portfolio. And as I mentioned, please let us know what ones we've missed out. Maybe there's some in our portfolio we need to kick out. And we will see you all next week for our 200th episode. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.